Everyone knows about Hong Kong's 0% tax rate on offshore profits, and as a Hong Kong accountant, I can tell you that it is absolutely true. But when clients from countries like Germany, Australia, or Canada first come to me, they often ask the same questions. Is this 0% tax rate some kind of shady, illegal tax loophole? Is this pass-through entity like an US LLC? How does the exemptions really work if that is not automatic? And most important questions, are there any personal tax risk to be aware of? You are going to get this answer to all these questions right here, right now. My name is Raymond, and I'm a certified accountant based in Hong Kong. I have helped thousands of digital nomads from over 50 countries set up their Hong Kong companies and legally claim their offshore tax exemptions to pay 0% tax. If you find this videos helpful, please give it a like and subscribe to my channel for more real-world insight on Hong Kong and international tax. Now, let's dive in. This is a question I get all the time, and the short answer is absolutely not. The Hong Kong tax system is fundamentally different from the other places, and the 0% tax rate is a completely legitimate outcome of a very well-defined legal framework. Here's a key difference. Unlike a US LLC, which is a pass-through entity where the profits are taxed at your personal level, a Hong Kong company is its own separate legal entity and a separate tax resident. This means the company's profits are subject to Hong Kong profits, which is completely separate from your personal tax status, no matter if you are the sole shareholder or director living outside or even inside of Hong Kong. Of course, you might be thinking of what about your personal tax risk? That is great questions, and I will cover this in the last part of the videos. The most important thing to understand here is the Hong Kong's territorial tax system. This means your company only pays tax on the profits that are sourced within Hong Kong. So if all your business revenue is generated outside Hong Kong, what we call offshore income, you can formally applied for the offshore claim exemptions to legally pay 0% tax rate on your corporate profits. This is a formal application process, not an automatic status, and it requires to fulfill some very specific criteria, which I will explain in the next. To qualify for the offshore tax exemptions, you have to pass two tests: operation test and documentation test. The first and the most straightforward test is the operation test. To qualify for the 0% tax rate, your core profit generating activities simply cannot happen in Hong Kong. This means no Hong Kong customer or suppliers, no physical setup in Hong Kong such as the office, warehouse, or even local server, no employees or staff based in Hong Kong, and the director and the shareholder, you should not living and working in Hong Kong in a year. Now, rules are rules, but let's look at some real-life examples. A client recently asked me about sourcing products from the Hong Kong company that shipped from mainland China. In these situations, you have to look at the totality of the facts, not just the supplier's registered office. It is very common for the Chinese factories to have the Hong Kong companies for the cross-border payments, so paying them is perfectly fine. The tax authority will be more concerned with the actual operational work, like where the contracts are negotiated, where the quality control happens, where goods are stored, and where they are shipped from. As long as these activities are not happening in Hong Kong, your offshore claim is quite strong. Similarly, if your online business has a small number of customers from Hong Kong, it usually won't be an issue as long as you have no active marketing or intentions to serve the local market. The overall operations is what matters the most. It doesn't matter if you pass the first test in theory if you cannot prove it on paper. The offshore claim approval process typically takes about 3 to 4 years and almost always include very detailed tax investigations. During these investigations, the tax authority will ask for documentations, and more documentations. For example, the e-commerce business, they will want to see your Shopify transaction records, payout reports from Stripe and PayPal, purchase invoice from your suppliers, and shipping documents that prove your goods went directly from your factory to your customer without going to Hong Kong. They might even ask for the email correspondence to show that your customer support is all managed outside of Hong Kong. So the key is creating a clear paper trail that proves every step of your business happens outside of Hong Kong's borders. The personal tax risk. This is a critical point that many people might completely overlook. In Hong Kong, your company tax liability and your personal tax liability are two completely separate things. Your company can legitimately pay 0% tax in Hong Kong, but it doesn't mean you are tax-free everywhere. The main risk you face is at your personal tax residency level, which is governed by the international tax rule like the Controlled Foreign Corporations (CFC) rules and the Common Reporting Standard (CRS) rule. Long story short, the CFC rules are designed to prevent tax evasions by identifying the central management of your offshore company. For example, if you are living in Germany all the time in the year, and you are the sole director of your Hong Kong company, the German government may decide to treat your Hong Kong company as a local German company and tax it accordingly. On the other hand, the CRS rules requires the financial institutions like the banks and brokers to report your financial details to the tax authorities of the countries where you are the tax resident. This includes the bank account details of your Hong Kong company for which you are ultimate beneficial owner. Now, while this rule exists, a key thing to understand is how different governments interpret and react to them. This varies greatly by countries. For example, some governments like Europe have very strict rules to tax foreign income, while the others like Thailand, Indonesia are often more flexible and relaxed, especially if your money is not remitted back to the countries. This is a big reason why many of my clients they're moving to this place. To wrap up, the Hong Kong 0% offshore tax rate is a serious legitimate process. It is not a tax loophole. It requires passing the operation tax and the documentation tax. However, the most significant tax risk is often not with the Hong Kong tax authority, but with your personal tax residency. It is a highly complex area that really depends on your specific nationality and where you choose to live. This is exactly the kind of personalized issue we can break down in a private call based on your exact backgrounds and plans. Feel free to book a one-on-one consultation call with me using the below link. I'm happy to help. Thank you for watching. See you in the next one.